Hello, everybody. Welcome to Friday. Another Talk Money with Tom show today. Really excited about today, actually. The market's having some struggles, and we're going to talk about some different strategies that you might want to use in this type of market. Present kind of what we're doing right now. I think these types of scenarios that we're in now, you can even learn more than normal. And so our objective is to kind of create an educational environment here where it would help our clients and others to have a more successful retirement. That's what we specialize in. We talk about asset management, we talk about retirement planning, tax planning, those types of things. So this is predominantly a question and answer show. You get questions from several sources. Number one, you can send them in at any time, including now, to the Ask Tom at Talk Money with Tom email address that's there. You can put them into the chat. We get questions during the week. And then I often present questions that came to me during the client strategy sessions that I had, just because I think there's things that everybody should hear. And so then Eason will be kind of moderator of those as we get those questions. He'll be asking for those. He's one of our other advisors here. And then, I'll answer, and then he'll add some pieces, and we'll go back and forth as far as that goes. So really looking forward to this. Again, if you're interested in trying to continue your education on this type of subject in terms of retirement, you can subscribe to the channel by hitting the subscribe button. You can hit the little bell right next to it as far as that goes. You can also book an appointment with us on our website, and you just go to the front page. There's a book appointment button there. A half an hour appointment, phone or video, where we can discuss some of your personal things as far as that goes. So really important for us to try to help with education here. That's our thrill with this particular show. So looking forward to today. I do like to start off every show with a summary for what I saw happening in the market this week. Awful lot going on right now with the market, really, having some troubles right now with the rates of return and what have you. So what I decided to do today is a little bit different. I want to present in fairly good detail, what we're doing in this type of market environment. The market just changed from an upward trending market to what I would consider, and I'll tell you how this works, but what I would consider a sideways trending market, and might be heading into a down market, might reestablish an uptrend. But there's different types of strategies that we use to invest depending on what type of market that we're in. And I want to describe the strategy that we're using now. I especially want to get this out to the clients because I do think that this time frame, there's some things we can do to take advantage of what's happening, but it's going to take a lot of patience. And that's one of the things I talked about last week, just really, having some patience for what might transpire here. So I'm going to share the screen and kind of show you some of the different charts and such to kind of go through. And I'm going to bring Eason in on this also so he can make some comments or ask some questions. And here we go. Okay, so what I have here is a chart for the leading economic indicator, LEI. This has been around since 1960. It's one of my favorite indicators to just look at overall economic situation. There's 10 indicators in this one basket. It's put out by the conference board. And you can see here, if you look closely, all of these gray lines are recessions, and the blue line is the indicator. And it's pretty amazing how many times that it peaked and came down prior to the recession, one after another all the way through time. And so that's one of the pieces I look at. I want to see how the economy is doing, because I have a big belief that in order to have a big downturn, you need to have a stock market downturn happening plus an economic downturn happening. And so those two together equal big downturns. The other type of downturns that happen here are pretty consistent. You get that 10, 15, 20% downturn on a fairly regular basis, but those often can recover fairly quickly, and you can actually take advantage of those if you know what you're looking for. So one of the other key things that I look at is interest rates, because they're one of the key drivers. Matter of fact, the thought of raising interest rates right now is what's driving this market downward as we speak. This is the Fed funds rate, which is when they talk about the Federal Reserve raising interest rates, this is what they're talking about. This goes back to 1955. You can see the different recessionary time periods. Also notice how many times interest rates were increased prior to the recession, increased recession, etc., all the way through, including, here's 2000 was on the rise, and then we had a recession, 2008, rise, recession. This increase right here that happened, more recently, we ended up with a 20% downturn downturn just in the S&P 500 at the end of 2018 before they started to lower the rates again in 2019. But right now it's at zero. Okay, so that's important. Generally speaking, when the rates are very low or falling, the stock market does quite well, and so we'll talk about that. So let's go back and take a look here just at 2000. Okay, so in 2000, the leading economic indicator was coming down, right? Really in late 99, early 2000. And then if we go look at the interest rates were on the rise, right? Flattening out a little bit, but rising in that time frame. Yeah. So that can be problematic. Two things: economy's coming down, interest rates are going up. And then here's the chart for the S&P 500 from 95 to 2005. And you can see, this up and down motion here. And this blue line is the 200-day moving average, right? And so here it turned down. So that's another thing that I use. So I consider a down market to be when the economy's coming down, looking at the leading indicators, interest rates are going up, and the 200-day moving average is going down. So that's a point when you want to get defensive, reduce risk as far as that goes, because we might end up with a downturn that's higher than 20% in that environment. And that's certainly what happened here. This is about a 45% drop in 2000. Right? If we let's just quickly look at 2008, right? So here's the peak, actually happened late in 2006 for the economic indicators. Here, 21 rate increases prior to that downturn. That's pretty dramatic, actually. And look what happened to the market. Again, went up, and then here at the beginning of 2008, the 200-day moving average turned down, and the market fell. Actually, I think it's 57% from high to low here on the S&P 500. So this would have been a point to get quite conservative. Yeah. Let's look at what's happening today. Leading economic indicators, straight up. They're not curling yet. They could, but they're not yet. We just got the report today for the December leading economic indicator. It was up 0.8%, which is pretty good, actually. And the conference board that makes this indicator grouping projected that we would have a 3.5% growth in the gross domestic product for 2022. So that's better than we were doing before the pandemic. So we're supposed to have good economic growth. We already know that so far, over 80% of the companies that have reported earnings have beat their earnings by an average of 8.5%. So earnings are good. Again, market's down, right? So if we look at kind of what's happened here we go, right? This is the S&P 500 for the last 9 months. This is a regression channel. So I look at that for direction. So obviously it's up, but I put in a secondary regression channel here for starting on the 22nd of November. To me, that's an important point, because on the 22nd of November, the White House reconfirmed the Federal Reserve Governor Powell to be renominated for another 4-year term. And right after that, he met with the Senate Banking Committee, and all of a sudden things changed. They went from a period where they were trying to support the market. When the market would come down, they'd come out and say positive things, to a period where they were just aggressively talking about raising rates, cutting back on stimulus, eventually talking about reducing the balance sheet at the Federal Reserve to fight inflation. I believe that if I'm in power, if I'm a politician in the party that's in power, I'm much more afraid about inflation than the stock market. So in other words, every one of the voters out there who might vote for me is affected by inflation, but not every one of the voters that might vote for me is affected by the stock market. And so I think there's been a shift. And so you can see what's happened. I've got another multiple regression channel built in here from the 22nd to now. The market's essentially going sideways. So obviously you can see it's coming down here in this particular time frame, year to date. But I don't consider that a down market. This is my own definition. I don't consider that a down market until this 200-day moving average is going down, the leading indicators are going down, and the interest rates are going up. So interest rates are going up. We have that. We don't have the other pieces yet. So I have a different strategy for these types of sideways motion markets, or these, I think it's going to fall farther than what we're seeing here, but they're still the same thing to me. Until those things all transpire, I don't see really big downturns. I design portfolios so that that 20% drop is already kind of built in. You have enough bonds to mitigate the risk. So you maybe have 30% bonds or 40% or 20% bonds or 80% bonds, whatever it is. That's designed to handle these kind of 0 to negative 20% drops as far as that goes. And then I'll show you kind of what I do to try to take advantage of these. But that's the process that we're looking at. And so I don't see the big downturn pieces, but I do see that we shifted from an upward trending motion, different strategies that I use for that type of market, to a sideways trending. Again, different strategy.
Can you explain what a channel is and like how you create these channels and like what they kind of signify?
Yeah, that's a good question. So the middle line is a multiple regression line, which for all intents and purposes is kind of an average of all of the data points, the closing points all the way along. And so it's a sort of a midpoint, but also I look at it from a directional standpoint. So it's going up, right? And then the top channels depends on what. These are different channels. So this is what's called a 100 channel. It's just going to take into account, uh, both. So you can see it's touching down here at the bottom. So this channel is this wide at the bottom. It's going to be equally distance on the top. This is actually a a same thing, regression line in the middle. And then this is basically a standard deviation differential between these as far as that goes. So in the end, though, the middle line makes the most difference to me, which is just really looking at direction. So we went from an upward moving direction over that, this is 9 months period, to a sideways motion. Both of these are what's called multiple regression channels. And it's just a drawing tool that we have right here on this particular chart. I have a whole bunch of other things on here. The blue and the red part is the momentum breakout bands, and there's a whole bunch of things that I look at. This is actually a slimmed down chart versus what I normally look at on a daily basis, but the 200-day moving average is this blue line here, so that's a critical component for me. It is important that we're breaking through this 200-day moving average here on the S&P 500, but that's not critical. That happens fairly frequently, and we don't end up with a 30% downturn. So, because I don't design portfolios to try to get in and out on 5% drops or 10% drops, but I will get more defensive when the economic indicators go down, interest rates are coming up, and the 200-day moving average goes down. Just looking back historically, those three things were present most of the times when we had really big downturns. I don't want to ride through the next Great Depression. I don't want to ride through the next 60% downturn, but I am willing to ride through, the 20% downturns because you have to. They happen fairly frequently. And by the time you get out for those, generally the market's already starting back up. So, yeah. Okay, so here's I'll introduce the portfolio I have right now. There's some important components of this, and then I'll tell you how we manage this, which is a little bit different than what we used to do. So what we have here, we have 75%, this is our 100% equity portfolio, in broad market indexes. I'll describe those in a moment. And 25%, essentially, 24 to be honest, in targeted indexes. And so when I have an upward moving market, I'm trying to find pieces that are moving faster and higher than the market. And so that's what these generally will be. In this particular market where we got this sideways motion, I want to have things in here I have high confidence in, that even if they drop, I still want to buy more. And so for the big pieces, we've got the Vanguard Total Stock Market Index. This is like over 4,000 stocks. This is the most broad index that I can find, actually. And then we have two pieces of S&P 500. We've got the normal, Vanguard S&P 500 VOO, and then I have an ESG screened S&P 500 from State Street. And I'm a big believer in the ESG component. I have high confidence in that area. It's really growing. ESG is environmental, social, and governance. And so what they're doing is screening the S&P 500 for those criteria. And I'll show you how that's doing in a moment. But that's the big pieces. I've got a little bit of short-term real estate. This is very interesting. This is the S&P 1500. So we've got the S&P 500, right? So that's part of it. And then the next one is the S&P 400 mid cap. and then the S&P 600 small cap. If you add that all together, that comes out to 1,500. So these are all three S&P indexes combined into one ETF, again, by State Street there. What we're finding is that there's a quality screen. The Standard & Poor's chooses those. There's 4,000 stocks. Only 1,500 of them end up on their three indexes. And so they've been doing a little bit better than the overall stock market, I think because of that quality screen. I've got a chunk of semiconductor in here. This has been falling pretty well, but I'm a big believer right now. There's only certain companies that make semiconductors. The demand for semiconductors has skyrocketed. The future demand for semiconductors is probably going to continue. I saw an article the other day that the number of semiconductors in a car is 10 times higher over the last 10 years than it was, and it's projected to just keep going. I think we're going to have semiconductors in so many things, and there's only so many companies that make them, and it's very difficult for new competitors to come along because it's so expensive to open up these fabrication facilities, and it's very sophisticated. So I love the semiconductor arena right now. And then Apple, they have just an unbelievable loyalty grouping, and even though they have troubles once in a while and what have you, they continue to march along. People really like their products. Some people hate them, but the people that like them really love them. So these are things all the way around here that I have high confidence in. So if we're going to rebalance, which I'll talk about how that works in a minute, we're going to end up rebuying some of these pieces as the market comes down. I want to be able to feel confident that, if you're going to sell me Apple at a cheaper price, I'm going to take it until things all fall apart. I'm going to keep buying Apple at a cheaper price. For example, if you're going to sell me semiconductors at a cheaper price, all the way through. And so just real quickly, this is the 60% portfolio, just so you can get an idea. We have a breakdown on the bond portion. And what happens in a rebalancing situation is that sometimes your bonds held up a little bit better than the stocks, and you might be selling. We did a rebalance today. We had some of the BND sold because it held up better, and buying some of the VTI. And I'll describe some of the rebalancing here in a moment. But I wanted to get you an idea of kind of what's in there. We have two broad market, bond pieces here. One with iShares. This one's a little bit broader. It's got a little bit of high yield in it. This has got 17,000 bonds in it, so it's very, very broad. Short-term Treasury inflation protection securities do well in a high inflationary environment. An inflation rate hedged high yield. That's actually been doing very well on a relative basis. And then we have a managed Treasury inflation protection security piece in here also. So, this again is our 60% model. And if we look now, okay, here's VTI, right? I'm just going to quickly go through the pieces. So if you look at VTI, right, here's the channel. It's kind of showing an upward trend. Good. Last 9 months. S&P, the 200-day moving average is still going up. We're through the average on the price. Okay, so that's a problem, but the 200-day moving average still going up. So that's good. And this is a very broad, this is the entire market. It's one, I use it as an index, just for comparison purposes to all of my portfolios. Here's the S&P 500 as presented by Vanguard. Again, trend up. Price, actually the price is just now coming through the 200-day moving average as we speak, but the 200-day moving average is still going up. And then down here, this blue line, this is what's called relative strength. So what this shows is how well this particular investment has done versus, in this case, the total stock market index that we just had, this one here, VTI. So if we look here, you can see that it is doing better than the whole market as a whole, pretty consistently since mid-November, right? So I like that. I'm a big believer in relative strength, and that's what gives me conviction to want to continue to buy that, because it continues to do better than the overall stock market. The next one in here is the ESG screened version of the S&P 500. EFIV is the ticker symbol. And so look at that. That's been actually outperforming the total stock market index since back in October fairly consistently. Again, that's why I like ESG and whatnot too. So, and then here's the real estate. Again, 200-day moving average is going up. It's well above the 200-day moving average. Its relative strength is high. Here is the S&P 1500, right? Large cap, mid cap, and small cap all together. outperforming the overall market. Again, 4,000 stocks in the overall market, 1,500 here. The quality screen that S&P 500 is putting into this seems to be working at the moment for this particular market, and we're seeing outperformance. S&P, the 200-day moving average is going straight up. That's good. Here's Apple, well above its 200-day moving average. 200-day moving average is going up, and it's basically been flat, even against the total stock market index since middle of December. So it's not outperforming, but again, I like that. It's hanging in there as far as that goes. And then here's the semiconductor above the 200-day moving average. 200-day moving average still going up. This one's broken down a little bit in terms of this last rundown that it had. It has brought it below VTI instead of the total return. Having said that, the red line here represents VTI. So over the last 9 months, it's still ahead as far as that goes. But I like it. Again, I think that there's a good, reason to own these because of the fact that there's so much demand and they really can't create new companies here very easily. So, again, if it gets cheaper, I'll continue to buy it. And so here's how it works for the rebalancing. We have a tool called iRebal that we use. Yeah, it's provided by TD Ameritrade. And so what happens is we can create a band around each holding. And so if you look at Apple here, it's at 6% is our target in this particular model. And so what happens there is we have a band of 20%, which just means we can go plus or minus 20%. 20% of 6 is 1.2. So that means we can go to 7.2 or 4.8. And so that when Apple just floats around between 7.2 and 4.8, when it gets below 4.8, which means it basically dropped faster than some of the other things here, we want to buy more. Again, we have high conviction, high belief in Apple's abilities to do well and be at a higher rate at some point in the future. And again, if it's above 7.2, we want to, remove that piece unless we're in an upward trending market. So an upward trending market, I don't rebalance. I let the winners run. And because Apple, if it's on fire, I don't want to take pieces off. So again, we're not in an upward trending market. We're not in a downward trending market. We're in what I consider a sideways trending market. I'm going to continue to rebalance. And so we go through, and there's a 20% band around every one of these pieces. And here's the 60% model. Again, 20% band around all of these pieces. And we run the rebalancing tool on every day. We look at it, and just when we see a lot of rebalances that can be done, then we actually do it. I think we've done it 3 times so far this year. And it allows us to kind of go in and buy what's low and sell what's high on a relative basis. And that's what you want to do in this particular environment, in my opinion, as far as that goes, is just to be able to kind of have this, mixture that we can essentially allow to grow and then take advantage of these fluctuations that are happening. My base case scenario right at the moment is that, the market is having a tough time adjusting to what's happening here with the interest rate increases. And, we'll have to see how that plays out. But this is our strategy right now. And again, I bring this up because it's going to take some patience. No matter what, this market's going to struggle for a while here. I would suspect that we're going to have a tale of 2 halves, really. First half of the year could be a lot more rough, and the second half of the year could be better. We have a midterm election that could make the second half of the year better. All of these type of things. Inflation could be better in the second half, et cetera. So anyway, that's what's happening so far this week. A pretty long-winded discussion about it, but I think it's important once in a while to do a deeper dive. I would consider this more of an advanced educational component. The more you can understand about what I'm talking about here, the easier it will be to get through these particular type of situations. All right. What do we have for questions?
So when we're talking about rebalancing, how does the account taxable type really affect these rebalances? Because if I was in a taxable account, I don't feel like I could be selling and buying as much.
Yeah, that's exactly right. So we can do rebalancings on a constant basis now on a non-taxable account, right? Tax-free or tax-deferred accounts, because there's no transaction costs any longer, and because there's no taxes. But you get to a taxable account, you don't have a transaction cost, but you do have a tax. So we actually go through the taxable accounts by hand, kind of one at a time. And you really have to make a determination within those whether or not you should be taking that gain. And so sometimes yes, and sometimes no. And so, I have a whole bunch of different criteria and what have you. It's a different methodology, but overall the same concept. You're still trying to, take what has, what you have confidence in that has dipped and buy that and sell whatever else what held up the most in that time frame. So that's still there. So yeah, it's definitely a different total methodology. We use the iRebal just to give us a picture, and then we go through by hand and figure out what needs to be sold or bought or nothing, right? So a lot of times we don't do anything. We have to wait until there's a bigger differential to make it worthwhile. You also have to report each one of those transactions. So that can be kind of a pain. You don't want to have hundreds of transactions, on your tax return. So, we don't have to worry about that either on the IRAs or the Roth IRAs too. So, but it's a good question. It's definitely a piece of the puzzle.
Yeah, another question that we've seen a couple times is, should I consider a Roth IRA conversion when the market's trending downwards or in a down market?
Yeah. I mean, first you have to figure out whether you should do a Roth conversion. There's a whole bunch of criteria. We've talked about that quite a bit. In my opinion, you have to have the money to pay the taxes with some other asset, right? So that's actually a really big one. So if I convert $100,000 worth of Roth and it creates 20,000 in tax or 30,000 in tax or whatever, I have to have that money in some other vehicle, usually a non-IRA type vehicle, to then kind of pay. So not everybody has that. So let's just say you can do it. So that's the first question. Then the second thing is, should you be doing it more in a down market? My answer is yes, with one criteria, with one piece caveat. So first of all, when the market drops, let's say there's two different scenarios. One is I have a retirement account and I want to convert all of it. So it was 100,000 and now it is 85,000. Let's just say, right? Wow, I'm going to convert that whole thing and pay taxes on 85,000 instead of what was 100. That makes sense. Now there's some timing involved. Maybe it would even drop to 80. So, but nonetheless, when you're converting an entire account over, then, that makes a lot of sense. Most of the times though, the accounts that we're looking at are really big, and we're not doing all of it. And we're basically moving a portion of it. And oftentimes what we're trying to do there is fill a tax bracket bucket. So this is where it gets more complicated, but so let's just say somebody wants to make sure that they stay under the 24% tax bracket, which is around 330,000 ish right now for a couple. And they already have $200,000 worth of income from all these other sources. That means they could convert to 130,000, right? Over and still stay in that 24% bracket. I'm simplifying this drastically, but that's the idea. And so then what happens is, you kind of need to know what incomes you have. If you're going to push up against the edge of the tax bracket, you need to know all of your incomes that you had for that year, which you usually don't know till the end of the year. So we do an awful lot of Roth conversions in December, just for that specific purpose. But if I felt pretty confident that I might be moving $130,000, by the end of the year, I might do 50 now because the market's down. And what the advantage of doing 50 now is that I can move more shares. So let's just say I have 300,000 in Apple, right? That is now shrunk down to 270 or something. And I can move more shares to equal $50,000 now than when it was worth 300,000, right? Because more dollars per share. And then, I'm able to then, if that grows back to the equivalent of what it would have been when it was at $300,000, I have, some nice growth that was tax free. So again, down markets, you can transfer more shares for the same dollar amount. Or if you got an entire movement of an entire IRA over, it's worth less than it was, there's less tax. So yeah, I think that's something to definitely look at in this particular arena. I like taking advantage. The market's going to go down. It just is. I mean, it seems like it's been going up constantly, which it basically has, but that's not how it normally works. And so, what can you do to take advantage of it? I think this opportunistic rebalancing that we're working on, I think looking at Roth conversions is another way to take advantage of a downturn. And yeah, certainly be looking at that. So, that's a really good question.
Yeah, as an investor, like how do I like stay patient and calm with this volatile market? Because the last couple of years, the market's been going up, and I look at my statement and it's always positive, but now we're starting to see a little bit more red.
Yeah. So it's going to be hard. I'm noticing more angst within the clientele because, again, you go back to 2018, I think the total stock market index was up about 4 or 5% for the year. We had a 20% drop. You look at, there's been a lot of years here that haven't been that great. And, you kind of get used to that. But then you look at 2019, you look at 2020, we had a big drop, but the total market was up a lot. You look at 2021, and so it's been a long time. People have been getting statements that look good month after month after month. And, I always thought it was kind of chuckling myself when somebody asked me, oh, and it was like a 2% down month. I was like, wow, that's wait until we really get a big one. So now we're getting a bigger one. And this is going to get worse before it gets better. I have no problem thinking about that. There's a lot of downward momentum right now. And we've even seen the market fall apart on 2 different days, Wednesday and Thursday of this week, where it was up and then reversed. And matter of fact, the Nasdaq reversed over 1%, which it hasn't really done in 20 years. And so, there's some things happening as far as that goes. But the way to stay calm during this particular thing is to, first of all, that's where the education comes in. It's why we have this show. It's why we put out these videos. I stay calm because I know a lot about the different history of what's going on. So, give you an example. On average, after the first interest rate increase, which probably is going to happen in March, the stock market drops 6% on the S&P 500. But 6 months later, it's actually up 5% in total. And so on average, the stock market makes 10.4% in a year following a year that made over 20. Hey, that's last year made over 20. And so on average, the stock market follows earnings, right? Earnings are up 8.5%. 81% of companies reporting so far have beaten expectations. And this will be the 7th quarter in a row of beating expectations. The leading economic indicator is up, not down, not peaking, up in December. Could come down, but it's not happening right now. And in reality, interest rates are zero. Yeah, they're going to raise them. They're going to cut back on bond purchases. They're going to do all these things that will definitely slow things down and certainly impact demand. But so, yeah, I mean, here's some more. I mean, inflation is being caused by demand, which they're going to work on with the Federal Reserve, but it's also being caused by supply chain constraints. What happens if supply chain constraints get better? And I think there's a very good probability that they do. Throughout the end of the year here, we'll probably see supply. That's going to help inflation right there, allow the Federal Reserve to lower rates less. Inflation could be a lot less in the second half of this year. Look at what happens in an average midterm year, going back to the 1920s. Basically, the first part of the year is usually poor. Second part of the year is quite good. So again, if that's true, you want to do opportunistic rebalancing. So what can you do to take advantage? But a lot of it's just kind of understanding, what's out there, what's happened. That's why we do this show. That's exactly why I do this show. And because, negative news sells. If you look at what's out there, and I've said this before, it's one of the reasons we do concentrate somewhat on the positive just as an offset. Negative news is what gets clicks. We'd get a lot more views. I mean, a lot more, like a magnitude more, if this show was negative. If we talked about why the stock market was going to drop 30%. And there's so many of those guys out there. They're all over the place. We're going to have the greatest stock market crash in history coming up right now, that kind of stuff. Lots of clicks. So I think one of the ways to kind of help yourself in terms of your feeling of angst, watch our show. I mean, because we're going to bring you some of the positive pieces, and these are facts. I'll tell you when it's negative. I'll tell you when the leading indicator is going down. I'll tell you when the 200-day moving average is going down. Those types of things. But those aren't happening right now. So this is, until they do start to happen at this point in time, in my opinion, we're in what I call a sideways motion market. Again, that doesn't mean it won't go down. Might even go down 20%, but we're still kind of in that trending, motion. That trend was going up, and now that's stopped, and now we're going to go kind of sideways and get really, volatile, which is happening. And then we'll either reestablish an uptrend, we'll have a strategy for that, or we'll actually fall into a full-on downtrend, and we have a strategy for that. But have strategies. That would be another thing. I think that helps, right? Have some plans. What are you going to do? I have plans. I have paths. I have plans for every path that I can think of all the time. I love doing that, and that helps me. I look at downturns as opportunity. So that's another thing that I think helps with the feelings of angst that you might get, right?
Yeah, and just from a planner's perspective, or whenever we run a plan, we account for markets having downturns.
Yeah,
We don't account for markets always going up.
yeah,
When we run our Monte Carlo, there's times when the market drops a lot,
yeah,
and we have that. And
yeah.
so, as long as you have a good plan, you can weather this storm, and you should be. You can, if you have a plan, you know what you can handle.
That's a great point, right? I mean, think about it. The market, I think, is down. We just looked at, just you and I before the show started, from the very high point that the S&P 500 to the point it was at when we were looking at it was down, roughly 9%, right? And people are going to be concerned, and because we're so used to the upturn, especially, right? We're going to that statement that comes out at the end of January. People are going to be like, whoa, and but that is part of the financial plan. The financial plan allows, it runs 1,000 times through your scenario, and it allows the computer to randomly choose amongst all of these variables, including the stock market. And so some of those situations are pretty bad stock markets. And so then you can look at your probability of success. So what is my probability of success? Let's say it's 95%. What happens now? Okay, hey, I just had a 9% downturn in the S&P 500. I can run that Monte Carlo simulation again, and oh, look, I'm at 93%. That's still really good. I wouldn't worry about it that much until it got down to the 75% level or less, to be honest. And a lot of people are at 99 and they're just pegged up there. And even with this type of downturn, there is no change at all. So it puts a more longer term perspective into the situation by looking at your financial plan and seeing, because that's the ultimate, right? I mean, it's not how much your accounts are worth, it's what's going to happen to your retirement, right? Whether you're retired or not, what's going to happen to your retirement. That's a great point.
Yeah, and going to back to the financial plans, what if my financial plan doesn't work? What are some of my options to improve my odds of not running out of money? Because if I'm in my 90s and I run out of money, I don't really have any other options at that point.
Yeah, that's exactly what we try to fight against. There's so many people out there that don't have a plan. It's not live. They're not reviewing it with a professional every 6 months. It's incredible to me. I couldn't do it personally because you could be going down a path that you don't really realize that you are looking at running out of money at age 90, and you're 70 or whatever, 60 or something, and you don't know. And the plan at least give you some ideas on what's going to happen. So if your plan's not working at some point when you first start, then you look for all the different things that might be able to, enhance that plan. What do you have in real estate value? What might you do with that at some point in time? What can you do with your rates of return? How does that change things? Should you take more risk? Should you actually take less risk? Because sometimes if you take too much, that actually lowers your probability of success too, especially in retirement. And so those are all different things. How do you reduce your taxes, right? Because maybe your plan's not working because you have so much money going out in required minimum distribution taxes. And so can we mitigate some of that with Roth IRA conversions? How much does that impact the probability of success in the plan? I mean, there's a myriad of ways, and it's very custom. in terms of what solution's going to work for your situation. Obviously, one solution is to spend less. I try to stay away from that unless we really have to, just because retirement is about your lifestyle and trying to maintain that lifestyle. It might be better to try to figure out what to do with your home than to spend less, unless you don't want to do that. So that's somebody who is really really happy with their current standard of living and they have a house that's worth a lot. Are they willing to move to a cheaper home and at some point later, maybe even when they're 80 or something along those lines, to capture some of the money that's in that home and make their chances more successful, or all kinds of different things you could do with your home equity and those types of things too. So yeah, but it's a good point. It's something we deal with on a regular basis. A lot of plans don't work the first time we run them. They're not that good in terms of probability of success, and they need to be reworked and take a look at and figure out what can we do to make them work. And then that's an ongoing process, every 6 months, just continuing to look at it and continuing to have a path that works to make sure, because that's what you don't want. You don't want to end up, when you're 90 running out of money. That's for sure.
Yeah, and the nice thing about with these plans are it gives you 5 to 10 years to fix a problem. It's not like this instant I'm going to run out of money. You
Yeah.
got some lead time. And
Yes.
so maybe there's some fat in your budget,
Hmm.
maybe there's a couple of subscriptions to magazines or streaming services that you don't use and
Right.
that you could live without.
Right.
And so like maybe you just need to cut back a couple $100 a month and your plan works fine now.
Yeah.
And so just making these small adjustments, you don't have to very drastically change your lifestyle,
Right.
but it improves your success rate.
Yeah. Some of the big ones I look at are tax. Okay. So if I can reduce tax, that's not going to impact my lifestyle, right? At all. And so I'm amazed at how many people pay more tax than they need. And really, it's because they're not looking at tax planning, they're looking at tax preparation. When you only look at your taxes for that year and maybe the next year, it's really hard to make an impact. If you look at the tax projections for the rest of your life and then make small adjustments here and there, well, that's amazing how much difference you can make doing that. And the second place is like some of the big expenses, like mortgage, if you happen to have one. What about refinancing, right? And those types of things. So I'm not running into people with a 5% mortgage. And they're wondering how they're going to make it. Okay, go get a 3% mortgage. That's why it save a whole, doesn't change your lifestyle, other than the fact that you have to do a refinance, which can be very difficult sometimes, but that's short term. Yeah, exactly right. So just kind of really looking at the pieces that are in that. I try very, 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 very hard to protect the things that are really important and fun, the travel budget, the other things, the gifting and those types of things. And how can we find some of the things that are in the budget to reduce, if we're looking at that as an option, that don't have big impacts on the lifestyle. And there's usually a lot. It's amazing. And you're exactly right. Even just a few $100s a month differential sometimes really brings up the probability of success, because you're looking at that all the way through the rest of your life, plus inflation on that all the way through the rest of your life. And that's why it has such a positive impact to cut back even just a little. So you could go up 20% in probability of success by cutting back $300-400 in some of these plans that I've seen. So that's a great point, really is, as far as that goes. So okay, great show today. Again, we got into some more advanced subjects. I hope everybody really enjoyed this. I am really thinking right now that the more the more you're going to be able to get through these types of situations that we're heading for the first half of this year. So I'm grateful that you were able to join us today. I hope we're able to help. We'll continue to be here. Send in your questions anytime. And obviously, if you want to continue to get content, subscribe to the channel. If you want to meet with us to talk about your specific situation, go and book an appointment as far as that goes. And we will be here next week. Appreciate everybody coming. Thank you very much.